Welcome to Whiteboard Friday. This week we're looking at how lower dairy prices could mean higher house prices. What? How is that possible? It sounds bizarre, and it is, but we'll explain why that's the case. This week we saw a drop in dairy prices, another drop, 10%. And that really means now that dairy prices look like they're going from where they were a few years ago at $8.40 down to the realm of $3 to $4, and that high $3, low $4 mark. So you can see they've really gone by more than half. They've dropped by more than half. And dairy is a big part of our economy. Remember, it's about 30% of our exports. So this is a big deal. It does have an impact on our economy. Luckily, it looks like we're not going into recession just yet. But part of the response to lower dairy prices, of course, has been interest rates dropping. So they've already gone from 3.5% down to 3%. And now some people are saying they could go down to 2.5%, maybe even 2%. So another drop of 0.5% or maybe even 1% on the way. Now this is really important for the economy when we're facing the struggles, the headwinds of lower dairy prices. And it's important for a couple of reasons. Firstly is our exchange rate. A lower interest rate means that we're going to have a lower dollar. And that happens because people overseas look at New Zealand, they say, well, interest rates are dropping there. We don't really want to put our money into New Zealand just yet. We don't want to put our money in a bank in New Zealand. So therefore, they'll send less money to the country and the dollar falls. We've already seen it fall by around about 25% against the peak earlier this year. And that's likely to fall further as our interest rates drop further. That, of course, means that our exporters are more competitive overseas. A lower dollar means that they get more American dollars or yen or renminbi, whatever it is, for every amount of exports that they send overseas. So we get more competitive. The rest of our economy, although dairy is struggling, will benefit from that. Things like tourism and meat and forestry and our education sectors will all get a boost from the lower dollar. The rest of the economy also gets a boost from lower interest rates because it lowers the cost faced by businesses to borrow money. So that's one of the major costs of running a business, to borrow money for working capital, for investments, that sort of thing. So if you're facing lower interest rates, you're more likely to borrow, you're more likely to invest, and therefore keep the rest of the economy chugging along despite the lower dairy payout. In fact, it'll even help dairy farmers because, of course, they're going to be borrowing at $3 or $4 a kilo of milk solids. No dairy farmers are making money. In fact, they have to borrow to cover their costs. Lower interest rates means they can borrow more cheaply. So you can really see why we use interest rates as a sort of accelerator or brake of the economy. By lowering interest rates, you can really get the rest of the economy revved up. Unfortunately, we have tax advantages around housing. So that means that when we get lower interest rates, the good people of New Zealand very rationally then respond by saying, well, we've got more money, so let's shove it into housing. Because housing, compared to the rest of our productive sector, has tax advantages around it, house prices are likely to get a boost by lower interest rates. So already in Auckland, we're seeing a starting housing price of around about $600,000. We know that that lower interest rates, a drop of between 0.5% and 1% in interest rates, mean that the average first home buyer in Auckland, it means that their mortgage costs drop by between $2,500 and $5,000 a year. So it makes a big difference to the kind of house that you can afford in Auckland. So as a result, lower interest rates, we're likely to see that housing market bubble in Auckland continue to expand. That's how lower dairy prices mean higher house prices.